Hello traders, Gary Wagner here just after 10:30 in Honolulu, 3:30 in New York. It is Tuesday, February 16th, 2016, and this is the Daily Report for Gold and Silver. We do have gold trading lower today, second day in a row. This coming off an incredible top at around 1262. Currently, we're at about 1202. Interesting activity under dramatic pressure in trading last night as we saw it trade to a low of about 1191. The high today, 1216. That came in early in the session, I believe. Currently trading 1201, 1202, off $6 to $7. On today's report, we want to cover a couple of topics. First, has this recent move down caused any long-term technical damage? Secondly, we want to take a look at the last rally that we saw, use a thing called a Fibonacci extension to see how that lines up, and then also take a look at the recent low in the market and see if we can find some sort of correlation between that low and a critical Fibonacci number, and I think the results are going to be quite surprising. That's going to be all here on today's daily review. So traders, as I said, I've got three basic questions that I want to ask and attempt to answer for you on today's report. The first question that we have to ascertain is whether or not this most recent move down from these record tops at around 1260 has caused any kind of long-term chart damage. Quite the contrary. As we look at it, I have simply a daily chart and our longest term moving average that we tend to use, which is a 200-day moving average. It's this blue line here. As you can see, it is just basically under this top, which comes in roughly, I think it's about 1191. It also, quite interestingly, matches up with the low here when we look at it here, but now you've got it because of these lower prices at around 1130. But the key is this: whenever we look at a market in terms of a longer term perspective, if it's above a 200-day moving average, that signals that we could in fact be in a bull run or a bull market. The longer it stays, obviously, the longer that rally. But the fact that we are well above the 200-day moving average tells me that in terms of a technical basis, we have not had any critical long-term damage. So traders, the second thing that we do want to look at today is this most recent rally and how this rally really ties in with one, a Fibonacci extension, an extension of the wave 1 to wave 3, and also this recent correction found within the market, and how that fits in with any potential fib retracement number. And when we do that, I think you're going to find some very, very interesting results from these two studies that we talked about, a fib retracement and fib extension. First of all, we have this market throughout the end of last year really coming down beginning of December, and then about the middle or third week in December hitting this really new low that is sitting at around 1040. And from there, we actually see a pretty good rally from approximately 1040 up to these highs at 1110. Now, interestingly enough, the market corrects, and it corrects precisely 61% to 1071, and the fact that it made a higher high here and it was a subsequent rally from these lows tells us that that's the beginning of some sort of a bull rally. Now we enter into our wave 3, meaning wave 1, correction, wave 2, and when we go to wave 3, what we do is we bring in basically a Fibonacci extension. Now, what a fib extension will do is it will analyze the basic first rally length, meaning from here to here, we take a look at the distance between this low and this high, and then we create a fib extension starting from the beginning of the rally, which of course is going to be at 1071. And when we do that, the results are quite interesting, because what we'll see is that a 261% extension of wave 1 comes out to about 1250. Now, of course, the tops or the highs that came in were roughly at 1262. But if you look at where the market closed and opened on the next day, and this is, of course, just recent activity, this being Friday, and of course, yesterday we were closed, so this is a combination of yesterday as well as today, yesterday being Sunday. What we can see is that on a strong move or rally up, you'll typically see a move about 161% that of your wave one. So you get a wave one, wave two, 61%. Very, very good model in terms of the retracement. And it comes up, if it would have just halted here at 1181, that would have been a substantial rally. However, when you have a really protracted, extended rally, it can get as high as a 261% extension. And we actually have that going over that point, because when you take into account the high by far exceeded that particular point. Lastly, and this is really what I believe is now critically important, and that is, so now we have our wave one, we have our wave two, and now we certainly have seen our wave three conclude, and we can tell that by the fact that it sold off tremendously from that. When we do a fib basic retracement of just this wave three, our 38% retracement comes in roughly at 1189. We know that the low was roughly 1191. So you get a rally, 61% retracement, 261% extension, and then a 38% retracement. That's almost textbook there. And so we simply need to see if this particular level, meaning the level of 1189, holds. My sense is that it will, because it really lines up well when you consider wave one. Wave two is, there's our deep retracement. So we've gotten our 61% retracement, and typically on a 5 count, you'll have one deep retracement, 61, and then the other retracement tends to be a more shallow retracement. You can have the shallow retracement come in on as your wave two, so to speak. It doesn't have to be your wave four, but when you consider the fact that we've got a 61, a beautiful rise up of 200 or 2.61 extension of the move in one, then we certainly could see this market find some support, which brings us to our very last piece of the puzzle. And the very last piece of the puzzle is, if in fact we find support in this area, meaning the 38% retracement area, where could we see this final fifth wave move up? And so the way that we want to look at it is, we've got our wave one, we've got our wave two, our wave three, assuming we have concluded a fourth wave with a 38% retracement. We could in fact see wave one and wave five be of equal length, and that's what this line is here. It is a scalable line, so this particular line will give us the price move if in fact we see this market move back to 1 times the move that we saw in wave one. And so at a minimum, what we could see is this: wave one, wave two, wave three, wave four, and wave five either being a flat, this would be equal. And of course, 131, that would take us to probably right at around, I would say about 1290. But at best, we would get a flat if all we see is a equal move from wave one here and wave five. So all in all, after pulling profits on our last trade, tremendous profits indeed, I believe that we could be looking at a potential setup for our next trade. We just want to see the dust settle, and I want to see if we can get any kind of a V or key reversal candlestick pattern that fits in with our current model. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for another daily update review. Bye-bye.